Good evening, everyone. My name is Kiana Danielle. We're going to have a webinar today about how to trade quarter second of 2016 fundamental economic events. So today, actually, we were supposed to have this webinar last week. Unfortunately, we had to cancel it. So now we have the perfect time. Actually, it's a Friday, so a lot of numbers are already out. So today I would like to cover as many economic events coming up as possible, as well as covering some fundamental events. So before we start, let me thank you for joining, and please type in a Y for yes if you can. Number one, see me, hear me properly. So one Y if you can hear me, and double Ys if you can see my screen. This is a live webinar, so I definitely appreciate your interaction because that would mean that I'm not talking to a wall. So Veronica, can you hear me? Let's give a shout out. Melissa, Mohammed, everyone, thank you so much for corresponding. I see a hand raised. I'm wondering if that means that you have a question, or so the chat box over here is right on your widget. So if you have a question, you can just type the message and click send. All right. Okay, so before we start, let's get into some breaking news here. Today we had the NFB non-farm payrolls, and it disappointed with only 160,000 non-farm payrolls, which was much lower than the expected 200,000. And the unemployment rate held flat at 5%, but this may not be a bullish factor given the change to the household employment survey. So the United States, obviously non-farm payrolls were released for the month of April, and the median expectation coming into the announcement was for an addition 200,000 jobs to have been added to American payrolls. The actual print was 160,000, or minus 40,000 below the median expectation. And with that, today we had a very interesting market reaction to the dollar pairs that we're going to cover. So, all right, so let's get into the webinar. This is me, Kiana Danielle, CEO of InvestDiva, and yep, we're going to start with the U.S. events. Today in the agenda, I will try my best to cover as many countries as possible: the U.S., Eurozone, Australia, New Zealand, and if we have time, we will also try to get into Japan and the UK. So as I said, we already had the NFP numbers for today, which came out in red. And non-farm payrolls are very important, and the reason why, I mean, they're marked as one of the most important events in the economic calendar. And the reason why is that it presents the number of new jobs created during the previous month. So today we had 160,000 in May, so that means that this number, 160,000 jobs, non-farm jobs, were created back in April in all non-agricultural businesses. And the monthly changes in payrolls can be extremely volatile due to its high relation with economic policy decisions, which are, of course, made by the Fed and the central bank. The number also is subject to strong reviews in the upcoming months. So today we had this number that could, because it came out in red, that already could put a downward pressure on the US dollar because generally speaking, a high reading is seen as positive or bullish for the US dollar, while a low reading is seen as negative or bearish. And although previous month's reviews and the unemployment rate are as relevant as the headline figure, and therefore market's reaction depends on how the markets assess them all. By that I mean, so the non-farm payrolls today came in red. However, the unemployment remained flat at 5%. And yes, we would have preferred if we had a lower unemployment rate, but 5% is pretty damn good considering that we have come a very long way since the beginning of the economic recession. So it's almost cut in half. So 5% basically means that only 5 out of 100 people in the U.S. are now unemployed, whereas in the highs of 2009, 2010, the unemployment was above 10, which was pretty bad. So this is still a very healthy number, even though we didn't see improvement. So for speculators, an unemployment steady at 5% might not be a good sign for that day or that moment. So once this numbers came out this morning in New York, yes, the US dollar was pushed a little bit lower temporarily, and now the market is moving back up. So that is what you want to remember. We're talking about a long-term investment, especially today, because we're talking about what to expect until this Q2 is over, end of June. And with that, it is very important to put the 2 and 2 together. So unemployment is steady at 5%, NFP was red, so put together, it's not actually that big of a deal, and it shows that the economy is actually quite healthy. And this also has to be considered with Fed's statement, which came out a few days ago, and as expected, and as we talked about in our previous webinar, the Fed didn't make any changes to its policies last week. Without any press conference scheduled, though, forex traders did pay closer attention to the actual statement for volatility, and what they found basically can be summarized into 2 points. Before I get into the 2 points, I want to welcome the new attendees who are joining us to the webinar. Everything is okay? Everybody can hear me? Please tell me if you have any difficulties hearing my voice. If you can hear me, please do type in a Y so I know that you're present and you can hear me. So back to the points with the Fed statement. So first, for the first time this year, the Fed removed its statement that global and financial developments are posing risks to the U.S. growth. Instead, now they are simply monitoring these concerns as well as their inflation indicators. So Janet Yellen and the team in the Fed have also placed more emphasis on the domestic front, and issues like slowing economic growth, improving labor market conditions, and moderate household spending were discussed more than external risks. So as you might remember, beginning of this year, most of the central banks were the statements were more concerned about China and other countries in the global economy that could place a downward pressure on their economy, but this time the Fed was more concerned about the U.S. itself and domestic growth. So with that, the question is that will this mean that this time's NFP report would have more influence on the Fed's next decision or not? So today's NFP actually was also that the reason why this NFP was so important is important for the next Fed meeting in June because that is going to be the next rate decision on June 15th. And if we continue having well, steady unemployment rate, or worse, not a lowering unemployment rate, we could completely kiss the another rate hike in June goodbye. So other things that you would need to keep in mind, the next U.S. retail sales is coming out on Friday, May 13th. So it's going to be a Friday 13th. Hopefully the Friday 13th won't have a negative effect on like an unlucky effect on the retail sales. So the reason why retail sales are important is because it's a monthly data that shows all goods sold by retailers based on a sampling of retail stores of different types and sizes, except the automobile sector. And it is often taken as an indicator of consumer confidence, and consumer confidence, obviously, if we have the higher the consumer confidence, the stronger the currency, the stronger the economy, and basically better for the currency. So this report on May 13th is an advanced report which can be revised fairly significantly after the final numbers are calculated. And of course, as I said, a positive economic growth indicates a bullish movement for the U.S. dollar crosses. Do we have any questions? Up to now, we have already covered the Fed statement, the NFP numbers, and the upcoming events. Because today I'm going to mainly cover the major currency pairs that do have the U.S. dollar on our trading versus the U.S. dollar. This is the most important part of this webinar. So if you do have any questions, please feel free to type it down. So moving to our next major economy that we need to follow in the remaining of Q2, the Eurozone events. So first, let's start with the already out European Central Bank statement. As you might know, the ECB kept its policies steady, with the rate on the main refinancing operations, the marginal lending facility, and the deposit facility unchanged at 0%, 0.25%, and minus 0.40% respectively, while the QE program is kept at 80 billion euros per month. So these were, well, the negative interest rate policy was introduced a while ago, and basically what I meant by this is that they didn't make any changes and interest rates remain low. And in his press, the ECB President Mario Draghi relayed his confidence on the ECB's previous changes, basically the negative interest rates, and he said that the most important thing that they need right now is time to display the effects of the negative interest rates that they have already introduced. However, he also warned that risks to economic growth remain, well, quote unquote, I'm quoting right now, tilted to the downside, and that interest rates will likely remain low beyond the horizon of the asset purchase program. So with that, you probably noticed that when this came out earlier this week, the euro crosses just jumped up when ECB said that they're going to hold its policies, but then it dropped back down after Draghi's dovish speech. And so, yeah, we did have, so that actually with that, I do want to, before we get into the upcoming events, I do want to get into the euro dollar crosses and show you how these economic events impacted the euro dollar, because we already learned about what happened in Europe and what happened in the US. So this is exactly what happened. So so when the ECB monetary policy came out, the euro-dollar pair jumped up and it reached this level right over here at 116, which is also the high of back in August 2015. Please, everybody, let me know. Type in a Y if you can see my current screen. And my current screen shows my Orbex platform, the euro-dollar pair. Okay, great. Thank you so much for your answer. I just want to make sure that everything is okay. So the euro popped up to 116, and it's the euro is really acting the way we want it to, and it has been basically ranging, this is the minute chart, basically ranging inside a box right over here between 116 and 105. If you are subscribed to InvestDiva, you probably know that I mentioned on this day that if this pair breaks above 116, that could indicate further a reversal in the pair up to the Fibonacci retracement level at 120 around here, at 122 or even 120.16. But what happened is that it was not able to confirm above this. This range, it's called a rectangle right over here, because as you can see, since 2014 the pair has been just bouncing up and down, up and potentially now down again within this range. And so with that, the technical analysis with this kind of is pointing to now another range towards 105. With that, on the fundamental side, what we need for this strategy to come true is a more steady US dollar and growth in the US economy, which will help the US dollar get stronger. So when the US dollar gets stronger, as I've said this time and time again, euro-dollar, the US dollar is quoted second, and that means the stronger the US dollar gets, the lower this pair will drop, right? Because the euro is the lead in this. And for the euro-dollar pair to go up, we actually need a strong euro and a weak US dollar. So now that we have both the Fed statement and the ECB statement out, and we know that the Fed is not worried about the U.S. economy anymore as much, and and at least about the global economy as much, and the fact that Mario Draghi had a very dovish tone, that also on the fundamental side indicates a more bearish moves coming up in the euro-dollar pair. So we have 2 points right now. The technical, here we have a spinning top candlestick. Let me just zoom in so that you can see. On the monthly chart, we had a massive bullish engulfing in March and a smaller bullish, and now we have a spinning top, which is an indication of indecisiveness. So if you're still unsure if the euro-dollar would change direction and continue ranging towards back to the pivot levels at 111 and 108, maybe you could wait. I mean, this is for really, really risk-averse traders who probably they have too many trades already, or don't want to get into a trade at the moment. You can wait until June and see what happens to the next candlestick. If the next candlestick after this is bearish, that is a even stronger indication that the euro is going to drop back down, and our pivot levels are set at 111, 108, and the support is at 105. So the same is true with the downside breakout of this range that the pair has been moving back and forth for now over a year. Because if we look at the historical levels, back in 2001, euro dollar was below parity, below 1 right over here. So if the pair next time ranges, goes all the way back to down to 105, and that is when, again, we're going to really need to focus on what the Fed and ECB says and how the economies are doing. And if the U.S. is doing incredibly well, and I'm assuming we could see the pair reaching 105 in the next, well, let's say the average range time is 1, 2, 3, 4, 5, 6 months. So in the next 6 months, that is going to be November. That by then the American elections are already also handing out, and depending on that result, that is when it's going to be like the American elections and the politics are going to play a massive role on the U.S. dollar. And well, right now we're down to Donald Trump on the Republican side and Hillary and Bernie on the Democratic side. And some speculations say that, well, Donald Trump, because of his foreign policies, he might actually initially, if he is elected, the U.S. dollar might strengthen at the beginning and initially, because he has very high appetite for, wars and not collaborating with other countries, which, well, if he talks about going to war with ISIS, that could boost the U.S. economy. Unfortunately, not that I'm promoting that, but war normally is good for the economy, the U.S. economy, because that boosts the weaponry companies' exports and production, and it creates jobs, and a lot of troops go on the site and unfortunately get killed. But, well, that's the reason why, just so you know, that the U.S. And especially the Republicans like war so much. If Bernie is elected, well, because he is incredibly anti-Wall Street, potentially the initial reaction for the U.S. dollar would be in the downside. But we will know about Bernie versus Hillary pretty soon, I'm supposing. And if Hillary is out, I think she is not as much of a risk taker or, well, out there kind of a politician. So we could expect the U.S. dollar to remain steady in whatever direction that it has at the time. So in 6 months' time, we're predicting that a euro dollar would get back to 105 level, and a break below that level and a confirmation below it could increase the potential of going down to parity. Also, one more thing that you need to remember about the euro is in June, also in this quarter, 23rd, the referendum for Brexit. And if the UK ends up leaving the Eurozone, that could have a massive downward pressure on the euro, and it could actually accelerate downward pressure on the euro dollar. If they decide to remain in the Eurozone, then we don't expect the pair to, well, obviously before and after the referendum, and depending on the speculations, we can expect volatility, but it may not be a reversal or a breakout. So these are the things and the events that you need to keep in mind when it comes to the euro-dollar pair. All right, so we've covered euro-dollar. If you have any questions about this pair, please type in it now. I'm going to move on to our next major economy, and that is New Zealand. So New Zealand is interesting at the moment. They're not very happy with the appreciation in Kiwi, the New Zealand dollar, and the Reserve Bank of New Zealand, the RBNZ, provided a little bit of a boost for the Kiwi when it kept the interest rates steady at 2.25%. Their next meeting is going to be in June on the 8th. And so a closer look at the RBNZ statement reveals that they're not as worried over the financial market volatility and low dairy prices as they were in the previous months. And right now, the head of RBNZ, Graham Wheeler, and his team believe that the economy is being supported by healthy migration, construction activity, and tourism, and as well as actually accommodative monetary policy. So he tried, during the statement, he tried his best to lower the Kiwi, and he said that a weaker currency is desirable, but the investors and the forex traders who were paying attention in trading the Kiwi at the time, they paid more attention to RBNZ's concerns over a potentially heating housing market, which could become even more heated if the central bank cuts its rates further. So with that, we want to take a look at the upcoming events for Kiwi. We don't have that much coming out. So the next big thing out of New Zealand is the well, the GDT prices, by the way, right now, when I did mention that they're low, they were much lower than previous. So right now it's actually negative. It came out on May 3rd at minus 1.4%. Last time it came out at 3.8%. It was positive. So that was a big drop, but it seems like RBNZ is not as worried about it. Their employment change is improving. They're adding to their employment. However, unemployment rate at the same time is going up. It's still steady. It's at 5.7% for Q1, while for previous year it was at 5.5%. It's still on the lower end comparing to the Eurozone, which is much higher, and it's kind of around the unemployment rate that we have here in the U.S. But putting the two and two together, the employment and the unemployment for Q1, it's basically mixed and not a very massive indication of what is going on. And so the next Global Dairy Trade Price Index is going to be on May 17th. So if the GDT index, and by the way, as I mentioned, so GDT right over here is the global dairy trade, and what it is that it uses a weighted average of the percentage changes in prices of dairy. And because New Zealand relies heavily on dairy products, that is the reason why we follow this index when it comes to trading the New Zealand dollar. So the next important thing for Kiwi is, of course, the GDP, gross domestic product. The next GDP is going to be actually in June. So the ratio is going to come out on June 14th, and the quarterly and annual GDP for Q1 is going to come out at June 15th. So obviously, again, as I've mentioned this before, and also on the Investiva's education course, a higher GDP could have an indication, it could strengthen the and have a positive or bullish indication on the New Zealand dollar, while a falling trend is seen negative or bearish for Kiwi. So these are the ones that you want to keep in mind when it comes to Kiwi. One other thing you need to know is that, well, I mentioned before that New Zealand is depending on tourism, and considering that now it's basically fall and it's soon going to be winter in New Zealand, they do have amazing ski resorts over there. We could that actually Australians fly over to New Zealand for skiing, so that could actually boost the tourism industry this coming in the coming months. So that is something that you might want to keep in mind. So putting these together and going back to our chart for a quick technical analysis on the Kiwi dollar pair. Right, we need to do this. I'm going to start out from the monthly. The levels are from our previous webinar, and it still remains true. So actually one thing that has been added, I'm going to try to delete some of these because it's a little bit, all right, we're going to delete everything. And I'm going to delete this one as well, so that, all right. So the Fibonacci, the long-term Fibonacci remains true over here. I'm going to add my favorite indicator. Who can tell what it is? If you have been attending our webinars, you would know that my favorite indicator of them all is the Ichimoku Kinko Hyo. And the way that we trade it, well, simply said, when the prices are below the Ichimoku cloud, or better yet, when the prices just break below the Ichimoku cloud, that is a bearish indication. You also want to follow the other moving averages, and if they're all pointing in the same direction, that is again a bearish indication. Now in the monthly chart, the Ichimoku seems to be exhausted, but as you can see, when it did break below the Ichimoku cloud, it did go all the way down to 0.60, which was a low from back in 2006. So this just shows the importance of technical analysis and being able to identify support and resistance levels, right? So because this is a little bit too chaotic over here, I am going to try and remove it. All right, it's very hard to remove it. So bear with me here. I know it's a little bit chaotic, but I've also added the Fibonacci retracement level from here. And as you can see, the pivot level is at 0.67. It broke above it, and then we had a shoot of Kiwi up to 38% Fibonacci at 0.71. And now with the current events and the RBNZ basically saying that they do prefer lower Kiwi rates, and with the US dollar getting stronger, it basically went back down. We're now at 0.68. But if you look closely, what is interesting about this is that the pair is actually moving inside. Forgive the okay, it's moving inside a channel. All right, let's try and do this again. So this is the channel that we're talking about. So it's moving inside this upward channel, and we actually have an upward resistance level at here, and it kind of coincides at 38% Fibonacci. And the fact that it was not able to break above either 38% nor this upward channel, we could see that the pair continues ranging within this channel. So this was the monthly chart. I'm going to go ahead and turn it back to the daily. Okay, I was able to remove that one. It's pretty tricky over here. So delete this one. Okay, this is better. So the channel I was talking about, you can also see it over here in the daily. This is a smaller, shorter term version of this channel. Just to clarify it, it's around. Well, this is a shorter, it's a narrower version. We want it to be a little bit open, more open, but you can see that these are the higher highs. So over here we have a high and a high and a high. So it's gradually basically going up and up and up. And now we've seen this going down. So on the daily chart, it's actually a little bit more interesting because it is within a channel and it already reached the lower band of this channel over here, right? So with the NFP numbers being lower, it actually didn't change it as much. It came, the US dollar didn't change as much as I said before, and it is continuing within this channel. So right now, what I'm trying to say is that the monthly, on the monthly and the daily, we have two different sets of upward channels, right? So this is the longer term is started from back in June 2015 and it's continued right now. And then on the daily chart, we have a shorter term channel over here. We started back in 2016. And before that, if we zoom back, you see we had a double top pattern, very beautifully actually a beautiful double top pattern. However, it didn't really work out. It didn't. We were expecting it to go back to 0.62. It didn't, and it just stopped the downward trend at 0.63. So right now we're in a little bit of a dilemma with Kiwi actually, even though the normal, like even if you look back from 2001 also, you can see that the higher lows are going higher. So the lowest low back in 2001 was down in 0.39. The next low is back in, let me point it out over here, 0.49, and now this new low is at 0.60. So if you look at this could actually indicate that the pair, if you look at the habits, when every time the Kiwi dollar has reached a low, it has reversed and gone up, create a wave, reach another low, and then shoot back up. So if this proves to be our low in the recent decade, we could expect actually the pair to continue up towards the 38%, and then if it breaks above it, we could expect the 50%. But again, so with Kiwi, I'm a little bit cautious right now. And the reason is that, yes, so the technicals is pointing to the upside, and it basically most of our indicators are indicating a bullish trend in the pair. However, the fundamentals says a different thing. The U.S. economy is doing well. The U.S. economy doing well is actually also so the U.S. economy doing well, that means the U.S. dollar would get stronger. That would be that could be a bearish signal for the Kiwi. And also, not to mention that the RBNZ really wants the Kiwi to get lower. So right now, the fundamentals and the technicals in the long term for Kiwi dollar are not matching. So what I famously look at every time that I want to trade is the Investiva diamond analysis, that the best trades are when everything, the fundamentals, the technicals, the market sentiment, everything is pointing at the same direction. And right now, unfortunately, with Kiwi, we are not seeing the similar direction. And so if you really want to trade the Kiwi, I think your best bet at the moment would be shorter term trades because the long term just doesn't match. But the shorter term, at least we can see that the market has really been bouncing up and down within this channel. So you can continue on now that we've reached the 0.68, and we have later on we don't really have much coming out of New Zealand until May 17th with the global dairy products, and with the U.S. What we do have coming up, well, besides the retail sales, is the FOMC minutes on May 18th. So May 17, May 18, you can mark your calendars. These 2 days could create volatility in the Kiwi dollar pair. And if you're in short-term trading, that is when you could look at the outcome. Either you can do it before May 17th, before the dairy products are out, and speculate the market, or you can wait until May 18th after the FOMC minutes, after the results are out, and make a decision based on the results instead of speculation. So this is how you could trade the Kiwi dollar in this quarter. Next up, we have another country down under, down in the southern hemisphere. Do we have any attendees today from Australia? Any mates from down there? That would be good if we... All right, it seems we don't have any Aussies today joining us. So yeah, Australia also similar to New Zealand, they're heading into winter at the moment, but they don't have the skiing available over there, so the tourism could actually go lower in Australia. So that is one thing that they may not be taking advantage of coming up in the next few months. So the RBA also, similar to other countries and the zones that we just covered, they also had a monetary policy out in the so RBA stands for Reserve Bank of Australia, of course. And one thing that really stands out with Australia's economy is that their inflation dropped, and it wasn't good. They were not happy about it, and that is the reason why the RBA cut its interest rates from 2% to a record low of 1.75%. And they explain that while the quarterly data contains temporary factors factoring the subdued labor costs, low global inflation, and a not so overheated housing market, significant changes to the central bank's previous inflation forecast was the main factor why, the main reason why they cut the interest rates. But so they also had to actually, though, as if the rate cut isn't enough, they had to add insult to the injury, and they downgraded their inflation estimates once more. and now the RBA is expecting a 1% to 2% inflation range in 2016, way lower than its 2% to 3% estimate just 3 months ago. And of course, not surprisingly, the Aussie dollar took another step back across the board, specifically comparing to the US dollar. So let's take a little bit deeper look at what is going on in Australia's economy. So the inflation, as I said, dropped, and the head of RBA, Stevens, admitted at the very beginning of his statement that lower than expected inflation pressures were to blame for the rate cut. And even though Stevens also pointed out that commodity prices have firmed noticeably from recent lows, he followed this upbeat tone by saying that the pickup followed a long period of declines. And as shown by Australia's widening trade deficit, Australia's term of trade remains much lower than they had been in recent years. So the reason why commodity prices, of course, are important for Aussie is because Australia, the Aussie dollar, as well as Kiwi, there are commodity currencies, and their economy heavily relies on commodity transactions. So Australia, unlike the Fed, is a little bit more concerned about global economic uncertainty because of their heavy dependence on their trade activity, and the well-being of the global economy has a strong say on how demand for Australia's commodity products might fare. The RBA acknowledged that global growth forecasts have been revised a little lower recently, but also noted that the sentiment in financial markets have improved. And the most important country, of course, for Australia is China, because they have an agreement to trade with each other, and Chinese policymakers confirmed that the People Banks of China, the PBOC's efforts are starting to grow a little bit, resulting to moderate growth in, well, now the world's second largest economy. But still, even though this is good news, the RBA officials warned that conditions have become more difficult for a number of emerging market economies, and uncertainty about the global economic outlook remains for them. So that is one thing they need to basically keep an eye on, China. But other than global economy, let's take a look at domestic economy and the rebalancing. So the RBA policymakers assessed in their previous monetary policy statement that Australia is still in the middle of rebalancing its domestic economy. And what that means is that they're moving away from mining-led investment boom to non-mining activity. So they're trying to diversify their economy. And they projected that this will carry on for the rest of the year, although growth is expected to continue at a moderate pace. And when it came to labor market, they said that the indicators have been mixed, and possibly referring to the underlying weakness in their latest unemployment and employment reports for the month of March, because most of the gains were seen in part-time hiring, while productivity and earnings fell. So we're in a little bit of a mixed scenario when it comes to domestic point of Australia's economy. The housing market is another point worth noting. and the RBA statement also focused on the housing market risks. You see, so the central banks try to avoid lowering rates too often or by too much for the fear of stalking a housing market bubble like we had in the US back in 2008. And in their latest decision, policymakers noted that the potential risks from lower mortgage rates were lower than a year ago, giving them enough space to ease the monetary policy. And so the number that you want to look at is the housing loans to owner-occupiers, which grew at a steady pace at 0.5%, while loans to investors slowed to 0.3%, which means that there is less danger of overheating. So with housing market, the risks are not as much. So with that, so we're getting a little bit of a mix over here. Global uncertainty is more important for the Aussies. And coming up, we of course have a bunch of employment changes. May 19th, we have the employment change and unemployment rate of Australia. And the next important thing is at June, on June 7th, the RBA rate statement. So right now the interest rate is cut to 1.75, and depending on what's going to happen next, so actually one thing that I did forget is the RBA meeting minutes, as I mentioned over here, on May 17th. So the minutes are going to give us a broader glimpse of what the RBA members talked about during their meeting and what their tone really is, as opposed to just a statement that they print out. All right, and then so that will basically end the Q2 will be ended. The most important thing out of Australia is the rate decision, and if they decide to cut the interest rates once more, that would obviously have another downward pressure on the Aussie, while if they decide to keep it on hold, that would either cause a range or upward pressure. So let's take a look at the Aussie dollar pair chart to see what I mean by this. So we are now looking at the Aussie dollar. I believe it was back in January that I predicted a reversal in Aussie, and it has been going up. It did reach 23% Fibonacci right over here, and then bam, we had the rate cut and a US dollar economic growth, and now we're reaching a pivot point again at 0.73. So the funny thing is, all these points, these are I haven't changed these levels, and it's interesting that the market really do follow these support and resistance levels. So it's very important that you follow up with what you have analyzed before. So if we look at the monthly chart first, I'm going to go ahead and add the Ichimoku cloud temporarily. Where is our Ichimoku? Over here. So the pair remains below the Ichimoku cloud. It already broke below it though a while back, right? And now it tested the 23%. It wasn't able to break above it. And now it's testing the pivot level at 0.73. So in the coming months, as we said before, we already had the NFP numbers, which were bad for the U.S., but guess what? It didn't really change the direction of the U.S. dollar, and the U.S. dollar is started to get strong again after its downfall of from back in January. It started to get weaker, but now the US dollar across the board, as you can see, has started a rebound, and we're seeing a little bit more bullish on the US dollar, which means the Aussie versus the US dollar pair is going lower, testing 0.73, and then we have the pivot slash support at 0.68 right over here. All right, so right now on the monthly chart, we are on a wait and see zone because it's just testing 0.73, but it hasn't broken below it. So I wouldn't make any long-term investment decisions when it comes to Aussie at the moment. Also, if you look at the daily chart, you can see that the prices have just reached inside the HMO cloud. That is another indication of consolidation and decisiveness. So now that we have this pivot level set at 0.73 and we have HMO cloud right over here, for a very strong indication of a bearish indication for Aussie dollar, I would wait not only for a break below 0.73, but also a break below Ichimoku. So a break below the Ichimoku cloud would be a stronger bearish indication, and the moment it breaks below Ichimoku cloud, that could be a strong indication of a bearish reversal of this recent uptrend. And for the levels that you can look at, I can actually use Fibonacci retracement levels. Right over here, as you can see, it actually kind of falls right, so the 50% is right at, if I bring it this lower, the 50% falls right at 0.73%, the pivot level. This makes this pivot that much more important. A break below the HMO cloud is also a break below the Fibonacci level, so that also shows another bearish indication at the time if it happens, and that could actually open doors for further down moves towards our previous low back in January at 0.68. However, this time, I suppose if it does go the down route, it might not be able to quite reach our support level right at this level, and it could be a little bit higher up at the previous low, probably around here, because the sentiment might not be behind it as much as it was before, right? So I'm going to color this. This is a support level, actually. This is another support for us over here. Then I'm going to color in purple. So these are the important levels that you want to keep in mind. Now, alternatively, as I said, right now we cannot say anything about this because Australia, well, they cut interest rates, they're going down. Will they or will they not do another rate cut? That is yet to come. And if they don't, and if they, I don't know, for example, suddenly decide to increase their interest rates, or if we have better economic data out of China, or if we have further weakness in the US dollar, the Aussie dollar could move back up, breaking above the Ichimoku cloud. The moment it breaks above the Ichimoku cloud, that is a very strong bullish indication. Your resistance levels and targets are at 23% Fibonacci at 0.76. And the other one, the next one, the extended one, is our recent high at 0.78. So that concludes our coverage of all these economies. So you can find more on investiva.com about my points of view. We have a must-read. Definitely go over there and take a look. Subscribe to investiva.com. If you are new to investing, definitely do buy my book, Investiva's Guide to Making Money on Forex. It's available on Amazon. Follow me on Twitter, @KianaDaniel for personal news, @Investiva for Forex news and more, any other investment strategies, including stocks and ETFs. I'm also on Facebook, both Kiana Danielle Investive. I'm on Instagram at Kiana Danielle, and I have hundreds and thousands of videos on YouTube, so definitely do subscribe on our YouTube channel as well. Again, thank you so much for joining us, everyone. I really appreciate it. If you have, don't forget to sign up for the next webinar at orbex.com. If you have a question or if you have a topic in mind that you want us to cover, also write to orbex.com, and we will make sure that we cover and answer your questions. Thanks again, and I hope I'll see you in our next webinar.